interest rates are finally starting to shift, and if you're an investor, this could quietly become one of the most important financial turning points of the year. For the past couple of years, high interest rates have shaped everything from stock market behavior to real estate trends and even how much you earn on your savings. But now, as central banks begin signaling or implementing rate cuts, the entire investment landscape is preparing for a reset. So what does this actually mean for your portfolio, and how should you respond? Let's start with the basics. When interest rates fall, borrowing becomes cheaper. That means businesses can expand more easily, consumers are more willing to spend, and overall economic activity tends to pick up. But beyond the economy itself, rate cuts trigger a chain reaction across different asset classes. And that's where things get interesting for investors like you. First up, the stock market. Historically, lower interest rates tend to be positive for equities. Why? Because companies can borrow money at lower costs, which boosts profits over time. Growth-focused sectors like technology often benefit the most because their future earnings become more valuable when discounted at lower rates. So if you're holding growth stocks or considering adding them, this environment could work in your favor. However, it's not always a straight line upward. Markets often price in rate cuts before they happen, so timing and expectations still matter. Next, let's talk about bonds, one of the most directly impacted asset classes. When interest rates fall, existing bonds with higher yields become more attractive, pushing their prices up. This means bondholders could see capital gains in addition to income. If your portfolio includes long-term bonds, you may benefit more compared to short-term ones, since they're more sensitive to rate changes. On the flip side, new bonds issued after rate cuts will offer lower yields, which may reduce future income potential. Now consider cash and savings. During high rate periods, holding cash and savings accounts or money market funds can feel rewarding because of higher returns. But as rates decline, those returns shrink. This is where many investors start reallocating their money, moving out of cash and into high return opportunities like stocks, real estate, or dividend-paying assets. If you've been sitting on the sidelines, this shift could push you to rethink your strategy. Speaking of real estate, lower interest rates can be a game changer. Mortgage rates typically follow the broader trend of interest rates, so rate cuts can make buying property more affordable. This often increases demand in the housing market, which can drive up property values. Real estate investment trusts, or REITs, also tend to benefit, as lower financing costs improve profitability. However, keep in mind that local market conditions still play a huge role. Rate cuts alone don't guarantee a boom everywhere. Another area to watch is dividend stocks. When interest rates are high, investors often prefer safer, interest-bearing assets like bonds or savings accounts. But when rates fall, those alternatives become less attractive and dividend-paying stocks start to shine. Companies with stable cash flows and consistent payouts may draw more attention, potentially boosting their prices. So, what does all of this mean for your portfolio strategy? The key idea here is rebalancing. A rate cut environment often rewards taking a bit more calculated risk. That doesn't mean going all in on stocks overnight, but it may mean gradually shifting away from ultra-conservative positions and toward assets with higher growth potential. Diversification still matters just as much, if not more, during these transitions. It's also important to remember that rate cuts don't happen in isolation. They're usually a response to economic conditions, which can sometimes include slowing growth or rising uncertainty. So while markets may react positively at first, there can still be volatility along the way. Staying focused on your long-term goals is crucial. Finally, this is a great time to review your portfolio with fresh eyes. Ask yourself, are you too heavily weighted in cash? Are you missing exposure to sectors that could benefit from lower rates? Are your investments aligned with a new economic environment? Even small adjustments now can make a meaningful difference over time. In the end, interest rate cuts aren't just a headline, they're a signal that the financial environment is shifting, and with it, the opportunities available to you. By understanding how these changes ripple across markets, you can position your portfolio not just to react, but to take advantage of what comes next.